The Federal Reserve is set to kick off its two-day policy meeting today. Check out the futures this morning. We're in the red. Dow futures now down by about 75 points. S&P futures off by 15. The Nasdaq down by 70. Joining us right now is Emily Roland. She is co-chief investment strategist at John Hancock Investment Management. And Emily, a lot riding on what the Fed has to say this week. You got any wagers on where you think they'll come down?
Yeah, the Fed's very likely to hold rates. They might suggest one fewer cut than what was suggested in the December summary of economic projections, which was 3 rate cuts. Maybe we'll see 2. You know, over the course of this year so far, it feels like there's been a lot of risk taking in markets. It's almost like the feeling of spring break is permeating investors right now. And Chair Powell may need to come in tomorrow and be the adult in the room and break up the party a little bit with more of a hawkish bent. I think one thing that's made his job a bit more difficult over the past month or so is China. China was in deflationary mode, and now all of a sudden we've got stimulus across monetary policy, fiscal policy, and this is sending a growth impulse through markets right now. And one of the biggest beneficiaries has been things like copper prices. During times where we have rising industrial metals like copper, that tends to indicate a reacceleration in growth, a reacceleration in inflation. And I think that's certainly complicating the Fed's job tomorrow.
Emily, if you look at the Treasury market, it does seem like that market has kind of figured out that fewer cuts are coming and that it's going to take longer before they start. We've seen yields pick up pretty substantially for both the 2s and the 10s. But equities aren't there, and I'm trying to figure out how much of that is the delayed reaction and not really paying attention to this, or how much of it is because there's still so much enthusiasm around NVIDIA and the entire AI story, just in terms of innovation and what might happen.
Yeah, we think it's the second one, Becky. You know, you've seen this environment in which risk assets have really paid no attention at all to the macroeconomic backdrop. You know, we've seen rates back up. We've seen a recent strengthening of the dollar, which is being accelerated this morning on the Bank of Japan news. And really, equity markets have shrugged it off. There's been kind of this everything is awesome sentiment that's baked into markets. You know, you're continuing to see the economy do okay. Q4 earnings were kind of just good enough. You know, we look at technology in particular, you know, even though the valuations are very much extended, there's really no fundamental problem with the tech sector. You look at Q4 earnings beats around 90% versus 75% for the broad market. The magnitude of those beats, a full 10% higher than the broad market. The challenge, of course, is it's really tough to argue that tech, AI, chips are not overbought at this juncture, but investors are continuing to ride that momentum wave. It's a tough force to fight right now, and that's really what's been causing this continued resilience across risk assets.
I guess if you were to tell an investor where to lean, what to do, what are you thinking? You're feeling good about things? You're getting nervous? You're feeling good. Okay.
Oh, sorry, I was responding to your producer, but, you know, within technology stocks, I think I heard your question. Within tech stocks, you know, we're not downgrading them. Again, they rank highest on our quality metrics. We like quality for great balance sheets, lots of cash, great return on equity. We're seeing that in tech, but you have to diversify into other parts of the market to manage that valuation risk. So we like areas like U.S. mid-cap equities, which are trading at the steepest discount to their large-cap counterparts since the late 1990s. We look at healthcare stocks, which have been left behind. They're now trading at a 10% discount to the broad market and should benefit in a period where economic growth continues to decelerate. And we also think areas on the value side, like energy, deserve a look right now. We've seen, again, with China's growth impulse, we've seen demand for energy pick back up. We've seen supply limited there. So I think there's a lot of opportunities to capture on the value side as well.